Good morning and welcome to today's 5 with Fitz. I'm Keith Fitz-Gerald, your host. Thanks as always for watching. Anyway, the S&P 500 looks set to snap an impressive 6-day winning streak as I record this. I say, bring it. The markets are repricing risk, something we've been talking about since Sunday, and that, my friends, spells opportunity, especially now. I say that because the bond yield to equity yield correlation that is normally close to 1 is practically 0 at the moment, which means that the market's usual risk-reward signals are broken, or at least on holiday lately. Put another way, bond yields are screaming danger, but stocks aren't listening. Now, historically, this kind of disconnect doesn't last. You can bet that either stocks catch a bid or bonds do. My money is almost always going to be on the former. Here's my playbook. Number 1, what if Jaime Diamond is right? Now, JP Morgan CEO Jaime Diamond made headlines this week saying that he thinks the markets are way too complacent. What gives him pause? Well, Diamond's watching earnings and he's betting they're heading lower. He's also concerned about deficits, tariffs, and what he sees as central banks asleep at the switch, an opinion I share. Now, should you worry? That's really what it comes down to. That depends a lot on what you own. If it's the broader S&P 500, probably. If it's POS stocks and you know what POS stands for, definitely. If it's world-class names like those we speak about frequently, hardly, as in hardly at all. Look, I know this is a big call. Diamond sees more deal flow, balance sheets, and executive dashboards than almost anybody alive. But here's the part I want you to take away. Diamond isn't panicking. He's preparing, just like he has dozens of times over the year. If I know Jaime Diamond half as well as I think I do, because I've been talking about him and watching him and focused on him for years and years and years, I'd be worried if he didn't say something right about now. If earnings come down, so will prices, and that's not a reason to run, but instead to tighten focus on the great companies with pricing power, fortress-like balance sheets, real moats, and mission-critical value, stuff we talk about all the time. Now, again, I told you Sunday that traders are going to reprice risk, and now Diamond's effectively telling you the same thing. And not for nothing, but it's not often I get to beat him to the punch. So hoo-yah. As always, it's an opportunity for investors who are paying attention. Now, number 2, D-Wave. Should you buy it? Shares of D-Wave Quantum jumped more than 27% after unveiling their new Advantage 2 system, supposedly the company's most advanced quantum platform yet. Now, that is a ginormous number, but it's important to remember we're talking about a $16 stock, which works out to a $3.51 move you get in an hour with a choice like Costco, just to pick a name at random. CEO Alan Baratz called it an engineering marvel, and I don't disagree. It is. However, D-Wave's flex is impressive. They're still a few qubits short of being king. The game is still very early innings. Quantum computing isn't just sci-fi anymore, folks. It's the engine under the hood of next-gen AI, drug discovery, climate modeling, national defense, and a dozen other industries you haven't even remotely thought about yet. My take? Forget the headlines. Follow the plumbing. The real money won't be made chasing 30% pops like an overcaffeinated day trader, although, to be fair, that can be really fun when you get it right. It'll be in the infrastructure, the chips, the cooling systems, the raw power keeping quantum alive and humming consistently. Now, personally, I prefer a few different quantum names like those we talk about in One Bar Ahead and we'll be circling back to soon because they're considerably farther along the line to commercialization and have more viable tech in my humble opinion. But that's just me. The point I want you to think about, my friends, is that investing perspective is the same one that stopped CNBC Kelly anchor. I rented lips today. The perspective I want you to think about is the same as that which I shared with CNBC anchor Kelly Evans and stopped her cold a few years ago when I said that AI isn't just another tech wave, but very likely, quote, the biggest investing theme in recorded human history, end quote. A narrative that not for nothing others have begun to parrot. Now, I see that as good because every time they do, it's more money coming into stocks that smart investors, hopefully like us, already own. Now, I hope you're on board one way or another because quantum computing is the real deal. It's the next big leap, and it's going to have a ChatGPT moment all its own, probably a lot sooner than people think. Now, number 3 today, Uncle Elon, as in Musk, Pinky swore to stick around for at least 5 years. And, of course, Tesla shares are up more than $10 as I type on news that he did that. and that he's going to be in the driver's seat for at least 5 more years. Now, demand is growing everywhere but Europe naturally, and that FSD has no regulatory barriers down under. Now, investors love this, even though it'll probably give some of that price gain back in short order. I do too. Having the world's most innovative, albeit controversial genius at the helm is exactly the kind of stuff that fuels the kind of long-term rocket ride into AI, robotics, energy, and autonomous transport that most CEOs wouldn't even remotely dare attempt. Now, you know the drill here just like I do. I think $500 a share just got a whole lot more likely. Number 4, 3D printing just got a Palantir upgrade. Now, how cool is this? I have long maintained that 3D printing will radically change our world when it gets to scale, and we can move from cheap plastic toys on home printers to serious industrial level parts. Now, guess who just entered the game? Team Carp has just announced a new partnership with Divergent Technologies, aka Divergent 3D, the company behind DAPS, which is an end-to-end factory-in-a-box that combines AI-generated design, industrial-scale 3D printing, and robotic assembly to churn out aerospace and auto-grade parts on demand. It's lighter, it's faster, and it's cheaper than conventional manufacturing. So now the point I want to make is that tech is being embedded directly into Palantir's Warp Speed platform, giving ding, 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 defense and commercial users the power to spot supply chain threats and instantly launch just-in-time production of mission-critical components. Now, that's a game changer, pure and simple. It's also another step in Palantir's push to become the operating system for modern manufacturing. Carpus Maximus sees the day. And, by the way, history, if you're not paying attention, history suggests there are 10 to 15 Palantirs out there right now, which is why your job as an investor is to find them. Now, the OBA family has already got a few on deck, in case you're wondering, and would like to join in on the hunt. And if you do, you know where to find me if that's of interest. Number 5, this is a big one. Why Moody's U.S. ratings follies are cratering Japan's bond market and why you should care. Yields on Japan's super long government bonds, 30 and 40 years, are just spiking to record highs. It's a sign that the market is starting to lose patience with fiscal overreach, even in a place like Japan that has long defied what I call debt gravity. Now, the 30-year long Japanese bond yield jumped 17 basis points to 3.14%, and the 40-year soared to 3.6% after weak auction sparked a sell-off. Translation, the market just sent Japan a warning shot. Demand is drying up and investors want more compensation to take on long-duration risk in a country with heavy debt and no clear fiscal consolidation plan. But here's the kicker, and this is where you want to pay attention to. What most investors don't realize is that Moody's U.S. ratings reset is a key part of what's driving this. In other words, what's happening here with Moody's is driving events thousands of miles away over there. Let me explain. When Moody's questioned the U.S. fiscal trajectory and outlook, now, never mind that it was late and a few trillion dollars short, actually. Never mind that S&P did this in 2011 and Fitch did it in 2023. Moody's was the last one standing, and when it reset, it triggered a broader rethink of sovereign debt globally. Big bond investors have started asking themselves, if Uncle Sam's not bulletproof, then who is? U.S. Treasuries are the benchmark global standard for risk-free debt. So if U.S. yields rise because traders demand more here, that forces a repricing of everything else, especially in developed sovereign nations like Japan, which have relied on even more aggressive fiscal stimulus and central bank support than we have here, as hard as that is to imagine. Anyway, the Bank of Japan may now be forced to pause or slow its quantitative tightening, but as one strategist put it, there's only so much central banks can do before they risk losing policy independence. Personally, I think they lost that a long time ago, but again, that's just me. Now, funny enough, and in case you got some time, I'll be talking about this with the venerable Scott Shelley, aka the Cow Guy, a dear friend and colleague, long time for decades, later today on RFD TV, and I hope you can tune in and join the conversation. Now, what does this mean for you and your money here? That's actually the important part. Defensive names could look a whole lot more attractive, particularly if they are low beta, high dividend choices like those I share with regularly with the OBA family and talk about here, both in Japan and the U.S. markets. Today's bottom line, super simple. Learn to embrace the uncertainty that others fear, or you and your money will get carried out feet first by those who do. As always, let's make it a great day. You got this, I promise, and I will see you tomorrow. Thanks for watching.